Hello everyone, welcome to my channel Money Steps. It's been some while I didn't posting any updates since December because there's not much difference for the market updates. So I believe currently there's potentials and the risks that I need to highlight to the investors at this moment. So I believe many people is still looking at the 2023. Will there be a recessions? We have heard a lot of news and read about news on the medias. So is this year going to be a recession's difficulty years? I would say Happy New Year first. So first of all, I would say go through the disclaimers. This video is for my own educational purposes only. Viewers should not treating this video as a buying or selling course. So today session will be using the browser to brief. I try to make it short. Okay, first of all, we're talking about 2023. Will there be recessions? So I Google it, so you can see the first result will be from the Bloomberg. So it would stated right over there, the advanced economy expected to have a slowdown in 2023, recessions in US, UK, stagnant in the Euro areas. So this is the results come out. So there will be a CNBC as well. Why everyone thinks a recessions coming in 2023. The Guardians. So you can see IMF is warning as well. This year would be not an easy year. The risk global recessions, world banks. So you can see a lot of medias and the international big companies, medias are telling everyone, investor, that 2023 will be a difficult years. Okay, so you can see UK faces worse recessions. So anyhow, now is January 8th, Sunday. I would say if we are expecting for the worst is coming, so definitely there will be opportunities underlying behind. So if you manage to catch these opportunities, I would say it would be helpful for your wealth generations. We'll go through some charting, and the first charting will be the Dow Jones. So we have looked in the Dow Jones charting here. So Dow Jones charting is going down all the way in 2022, and the it's rebounding, going up. So it's now coming back to the so the last, I would say the first week Friday, it managed to break out the trading box right over here. You can see the trading box right over here. The last trading day of the first week of January, there's a breakout because the employment details data is delivering a good data in the markets. It could be a good news and it could be a bad news as well with good employment data. So for what we know is that the inflations currently is very high at this moment, although it's declining in the US market. So declining, we look at the chart of the inflation is 7.1%, is declining all the way from 9.1 to 7.1% over the months, and which is a good news for the declinings of the inflations. And the but the unemployment rate is still remain low. So I would say with a good employment data and good inflation's data as well dropping, so it's signaling that the employment is doing very well while the inflation is dropping. So meaning that the employment is fully in workings in the economics. So everyone they got their jobs and they got their pay as well. So we should thinking as whether the employment can be sustained. So during the inflation timing and the high interest rate timing at this moment, so we need to think it through. So are the employment or the employee getting a higher pay at this moment? If there is a higher pay in the economics, there will be a spiral of wage inflations coming in. So we can see that the rebounding in the Dow Jones from here, so which is a good signal. So we'll need to see whether it can be continuously going up for the Dow Jones. On the S&P as well, S&P is also break up for the trading box on the last Friday, so it could be trading upward toward the 3,009 or 4,000 level right over there, to testing the Dow trend line, the blue line right over here. So the Nasdaq, okay, is still on the downtrend, which is only abnormal sessions in the Dow Jones, which already break the Dow trend line and is staying right above the line right over there. So we look at the inflations and the interest rate by the Federal Reserve. Federal Reserve has been rising the interest rate toward the 3.75 to 4% range, and the inflation is 7.1%. So I would say there will be sooner or later, I would say expecting to be crossover in these years. So the Federal Reserve are already learning from the lesson in the hyperinflation's age back into 1980. So there has to be a crossover for the interest rate and the inflation rate. So to make sure the inflation is coming down all the way, okay. So we shouldn't expect the interest rate will be decreasing in first 1 to 2 quarters. I believe because the interest rate, the inflation will need to take time to come down. So even the Federal Reserve is expecting to have a higher interest rate, maybe another 50 basis points for the first quarters. So we see how it goes. The next thing would be the effective rate, as per I mentioned earlier. So this one is the charting about the interest rate by the Federal Reserve. You can see that the 1980 level, the hyperinflation age, the interest rate has gone toward the nearly to 20%, while the interest rate is actually about 14 to 15% only. So there has to be a crossover between these inflations and the interest rate in order to bring down the inflations. Okay, so this one would be the first signal. So we shouldn't expecting the interest rate going down if the inflations remain higher than the interest rate. Okay, so the next chart we look at the bond yield for the 10-year bond yields minus 2 years bond yields. So whenever these things break below zero, meaning that the bond yield of 10 years minus 2 years bond yield. So whenever the bond yield for 2 years is higher than the 10 years, so it goes to the zero. So whenever these things go to the zero for a period of time, we should expecting for the US recessions, which is the gray shaded areas, recessions. So back into 1980, so we can see there has been gone through 2-time recessions, and the 10-year minus 2 years bond yield is dropping below zero, and we goes to another 1989 So, and the recessions came in only in 1990. So the next would be the dot-com bubble. So recessions come in 2001. So, and then next would be the 2006 and 2006. The 10-2 bond yield is below zero. So we come into the subprime crisis. So now we are at the how many percent? Minus 0.7, about minus 0.7, which is lower than the subprime, lower than the dot-com bubble. So we should be a bit alert on these things. We don't know how low will it goes. We don't know when will it reverse back. So we know that at current stage there will be a uncertainty coming in. So anyhow, 10-2 is not the what they call the pinpoint by the Federal Reserve Powell. So Federal Reserve Chairman Powell is more referring to 10 years bond yield minus 3 months. So we have a look on the 10 years bond yield minus 3 months. So same, we can see that now this the 10 years minus 3 years bond yield is minus 1.12 already percent. So you can see that it's already worse than the subprime, worse than the dot-com bubbles. So you can see that so whenever we see this thing happen, we should expecting something. Sooner or later it will rebound one. Definitely, sooner or later, the 3 months will be 3-month bond yield will be lower than the 10-year bond yields. Sooner or later, matter of times. Okay, so when we are expecting this thing to be happen in the future, coming soon. So what we should looking at this moment? What should we looking at? Where is the opportunities at this moment? Okay, so this one is the 10-year bond yield. At this moment, you can see that the 10-year bond yield has been dropping all the way from 1981 all the way toward 2020. Okay, 2020. All this because of the interest rate. All this because of the interest rate has been signaling but implemented by the Federal Reserve. It's been dropping all the way for 40 years. So now they got no choice because the inflation is coming back to slap their face. So there has no choice but to raising the interest rate to bring down the inflations. It's pretty much like the 1980s, 40 years ago. So in this case, we can see that the bond yield is going up. The bond yield is going up for the 10 years. It's already going up. Back in 2020, it's already going up. So we can see this could be an opportunity for the investor to looking at the bond investing. So one of the bond that we can look at would be the 20 years bond. This one is the 20 years bonds, treasuries. You can look at the trending is going down and it start to forming pretty much like a bottom line. I mean, so because sooner or later the bond will be reversing. When it hit to the ultimate level, it will be reversing. So the bond would be the good investing tool at this moment. So you should look at the TLT. So it's not a buy recommendation, but we can look at it as a case study. So whenever this thing happen where the 10-2 years, 10-3 months treasury yield is below 0%. So sooner or later you'll hit the ultimate and you'll rebound, right? sooner or later it will hit the bottoms, it will rebound. So at this moment, so it's very rare that we can see this 10 years bond yield -3 below 0% for very long durations. So we should look at the potential in the bond. So you can see that the momentum is coming in as well for the TLT, 20 years Treasury bond. Okay, so we can see a lot of potential in the bond as well at this moment. So means that you can shifting your stocks percentage into more percentage into the bond yield at this moment. So because the interest rate has been very low, and there are contra relationships between the interest rate and the bond price. So I believe that's all for today. Thank you very much and goodbye.